Yo, what's up, guys? Welcome. Hope everyone's having a nice day off. Chilling at home, doing whatever you're doing. All right, let's just give it a couple of minutes to let some people log in, and then we'll get into this session. I'll just give it 2 more minutes, guys, and I'll get cranking on this lesson. Hey, just hold tight for a sec. That'll be awesome. How's everyone's weekend? Hope everyone had a good time. Chilling. Hey Ty, how you doing? Danny, Johan, Dave, Simon, Christian, Ottinum, Paul, Anu, how you doing? And of course, everyone's favourite little apprentice, Granvin, welcome. There he is. We've got ourselves an apprentice in the group. He's 17 years old. He finishes school at 2:30, rushes home, and is on at 3:30, ready for the New York Lives. How's that, eh? 17 years old. Imagine being that young and being so tuned in. Pretty impressive. See if we can't change this young man's life. Hard working, gotta be, that's right. Your parents must have instilled some good values in you, mate. All right, let's get cranking. So what I've got on screen here is, this is my entry setup, right? So I've got the 1 minute, the 2 minute, the 3 minute, and the 4 minute. And the reason why we're gonna do this on this particular setup is because we want these zones on our entry time frame, not on our higher time frames, right? So I usually just do it on the one. I link it to all of them, and I make sure I link all the drawings and just go up, and I'll just go straight to the daily. We can do it on the daily. I don't want to go too much higher. And basically what we're looking for is we're looking for the highs, right? So the wicks are the highs. Now, to start with, hey Eddie, to start with, we're going to have some pretty big ranges, right? So this wick here is 393 to 164. So, you know, there's a good 100 and something, nearly 200 points there, right? Pretty close to it. As we scale down and drop down through the time frames, this zone that I'm about to put in will start reducing, and we'll start getting a really tight little zone where you'll see price reacting as we drop down in the time frames. So basically what we're doing is we're plotting out the essential buy zones and the essential sell zones. You can call it supply and demand, you can call it support and resistance, whatever you want to. It's pretty much the same principles, but there's one catch. We know that institutional traders buy and sell at key levels. And once we plot these levels on the chart, you'll see exactly where those levels are. So let's get into it. I just use I just basically draw out a box. So this is and I'm only interested in the wicks, right? Wicks of the highs and wicks of the lows, right? So we've got this one here, and that's a daily zone. And then, as you can see, we've already got a reaction in that daily zone. We'll go down now and we'll look at the lows. So I'm not so interested in this one because this is the actual low currently of the play. We've retraced and we're coming down. Now, if this takes that down, then probably next week we'll put in a zone down here. But for now, we're just going to take this zone here. We'll mark that out. That's another daily. There's another one here. Right, and we keep going down. Now you can go as far as you want, but you don't want to go too far because the ranges that you're going to be dealing with throughout the week of trading, you know, it's not going to drop 1,000 points. It's not going to go up 1,000 points. So just keep that in mind. You want to keep it pretty tight, and the less you have on your screen, the better. But down here we can see we do have another wick here. As you can see, we've taken liquidity from this one. We've taken liquidity from this one. So this is the low of that period. We'll mark that out. Right, and actually we'll just go to the bottom of the run just as an exercise. Right, so what we're looking for, again, is highs to lows, right? Highs to lows down here. So we're just going to continue. I think we'll stop here, right? We're not going to go all the way down here. Actually, we'll put in this one here. That's the last decent one. Right, so that's our daily done, right? Now we're going to do this all over again, and we'll drop down to the 4 hour. And as you can see, our zones are sitting there pretty nicely. You can see the reaction. We've got the double top here. We come down. We're coming into this one. We've got a double bottom now in this area. So things start opening up a lot for us. So this one here, you can see, let me scroll in. So we're only interested in the wicks, right? So you can see we've got this doji right here. Wicks on both sides. We're only interested in the upper wick of a high and the lower wick of a low. So we're just going to pull that in. Right, so now we've changed that from a daily to a 4 hour zone. And now let's check. So, and as you can see, things are getting much smoother, nicer, and tighter, right? Now we do have a couple of additionals. So we now have this on the 4 hour. We'll just quickly mark that out. It's a tight little zone. This one hasn't been affected. That's still good on a daily. Let's run across to this one, and we can reduce that as well. Right? So it's this, let me just get a zoom on that. There we go. So again, we're only interested in the lower wick of the candle, not from the body down to wherever the wick stops. Because as you can see, this is the rejection area, right? Prices pulled in, rejected. Prices pulled in, rejected. Again and again. And what's happening here is on the sell side, sellers are pushing price down, but then buyers are jumping in at this level and they're pushing price back up. So that's why we're only interested in the wick area. So that's now a 4 hour zone. Right, let's go across and check out this guy. Again, we can reduce this. So this is the outstanding wick. It's the one that hasn't had liquidity taken on it. So we can now switch that over to a 4 hour. This one here. I think that was as low as we went. Yeah, cool. All right, so that's as low as we went on the 4 hour. Now we're gonna go back. As we saw, we put in this one here. We do have another one here that we might as well put in just for this exercise. There we go, that's a 4 hour zone as well. Right, cool. So now we're getting somewhere. So now we've got like some really nice dealing ranges, right? Let's drop down to the 1 hour. And all you're doing is going back over and checking to see if you can further isolate these zones, right? The tighter the better. So we can do that here. We've got that wick just here. right? And then we're going to come over, and I'll explain how we use these zones once we've marked them all out. It'll become a whole bunch clearer for you. One hour zone, drop down. Now this one here, see how we can do it. I'll do it for just the purpose of illustration. All right, we got this down here. Now we're reducing this daily. See how we, on the 4-hour chart, this particular zone, we weren't able to reduce, right? So we've gone from a daily now, and we're dropping down to an hourly zone. So that's cool, we can do that. We'll go all the way across. Let's get one here. So again, the 4-hour, we're gonna reduce that down to the hourly. This is our wick, it's the lowest wick. Every other wick has not taken that liquidity out. So we're gonna reduce this down, and that is an hourly play now. This bad boy runs all the way. Here we go. Nice. It's a 4-hour. Let's get it down to the hour. Just reduce it slightly. Right, cool. I believe that is it. Yep. Oh, one more. There we go. So this is, usually you're going to have hourly zones. You'll have 4-hour zones, and you'll have daily zones, right? So it just so happens that in this example for this week, we're able to reduce everything down to a daily, which is great. Usually you'll have a bunch of different time zones that you're not able to reduce down. All right, cool. There's a gap there too. So let's go back. All right, so let's have a look at this. All right, so what we've got now is we've got, let's just shift this, I knew that was going to happen. All right. So now we have our zones in down to the hourly time frame, right? Which is perfect because everything that we do in terms of entry or setups is always done on the higher time frame. So when we're coming up and around these zones, you can see there's areas of rejection around the top here. This one doesn't quite make it, but what will happen is we'll come close to it, we'll come down, we'll potentially bounce off the bottom, right? We can potentially bounce here and then go back up, or this is the other great thing about having these zones is if we go through and we come back and retest and reject and then go down, that's a good entry point for your continuation trade, all right? So there's a couple of ways that we use these in our trading. Number one is obviously if we're in a zone like we are now, then we know that price is going to be dealing from this area to this area, okay? If we break out of this area, then we know that we're either going to the top and this is now our range that we're dealing with, or we're going to the bottom of that range and now this is the range that we will be dealing with, okay? And whenever we break through, we can do a continuation trade, and whenever we bounce, we can just aim for the other side of the range. So if you have a look as well, let me just see if I can get it on my screen. Might be a bit better. Wait up. Oh yeah, here we go. If you have a look over here where these zones have been placed, 26,400, 26,000 and a bit, 25,500, 24,300, 24,000. Do you see where I'm going with this? They're all pretty much whole numbers, right? They're the psychological levels that everyone speaks of. So that's what makes them extremely powerful, right? Is these areas are where institutional players have placed or sold trades, right? So this for instance have been sold up and around this area. This one here has been brought up around this area. They're the psychological levels in the market, right? So what's that, Graham Van? So basically a break and retest. I'm not sure what you mean, but that's what makes these so powerful, right? So maybe a week or so ago, I was dealing with prints, single prints from a tool called Quant Tower. Now, what I realized pretty quickly is after I'd done a top-down analysis is there's a bunch of prints that are printed, right? But most of them fail. And the ones that weren't failing were the ones that were landing in these zones, right? They were all pretty close to these zones, either the top, the 50%, or the bottom. And they were the ones that were sticking. Now, you also find that when I turn on the indicator, which is the ICT kill zones and pivot points, you also find that these are the areas where we're sweeping liquidity, right? And we're dropping off, testing the midnight, and then dumping. So they're giving you the extra confluence you need to get into your trades. You can see what's happening on a grander scale, right? But you can only do that if you're watching the high time frames and then reducing down and then going down to like your entry time frame to find entries on once these zones have held, you're looking for either the retest and break, or the break and retest rather, or you're looking for the levels to bounce off of, okay? They're very strong draws on liquidity. These are where the institutional players are buying or selling their orders in bulk. And that's why they're so strong, because you get those big, they get the big moves straight off the bottom of them, off the top of them rather, or off the bottom of them, right? Huge moves. That's what makes these zones so significant. So that's just one way that we trade in the Discord. Super easy to do. It takes maybe 15, 20 minutes each week, but now you're set up and you know exactly where the institutional plays are, because if they've held once, they're gonna hold twice, right? So again, we've got this one here. Look at that. So it's held once, and the second time it's held twice. Double bottom and then ripped out of there. So if there's any supply and demand traders or anything of that nature, you'll totally understand how I use these zones and why they're so critical to everything that we do. We play trading, when you're trading long term, I'm not talking about like over a week or anything, I'm talking within the day. Over the week, over several days, you're going to be in a range where price is just going to go backwards and forwards until it either breaches a level or it goes down and breaches a lower level. And then you're going to slide everything down and you're going to be in that concentrated range. And that's all these are about. These are your trade dealing ranges. From this one to this one, from here to here, right? As soon as price breaks through the top of this, then we know that we're in this dealing range here. We know that this is our support and that is our resistance, right? And until that gets broken, we go up, then we'll be dealing in another range from there to there. Or if we go down, we'll be dealing with this larger range from here to here, all right? So when you start looking at things on maybe a, sorry, my iPad's in the way. I'm streaming on TikTok as well. Here we go. I'm trying to poke my head over there. There we are. All right, so when you're thinking about trades, if a trade's in a premium or a discount, it's a pretty easy thing to measure the range and then go, all right, cool, we're currently in a discount. We can look to trade back up into a premium. You can run your channels through these areas, right? So we got channels unfolding, breach of channels. As long as you're in the discount, you can look, if we breach outside of it, we can look to go long out of that channel and to the upside of that range. Do you see what I mean? There's several different ways that we can use these ranges. Quick question, once we pass through the level, do we still keep it on chart? Absolutely. Yeah, you don't, if we breach through it, the level is still valid. Because if you're a continuation trader, what usually happens is, right, price is going to come down, it's going to breach through a level, it's going to come back, and what's it going to do? It's going to retest it, right? So that means there's still existing orders sitting there for you to retest it to drive it down. Those orders don't disappear. They just keep getting stacked into the market at those levels. Institutional buyers don't buy or sell off of any structural pattern. They buy levels which present value. All right, it's not about like a head and shoulders or a fair value gap or a double bottom, whatever it may be. They don't trade patterns. They enter and exit in levels of value. And these levels of value are presented by these zones, Danny, right here. 25,500, 26,000, 24,300, 24,000, like it just keeps going. 22,800. It shows you the levels where they're buying and selling, because that's where we're getting all of the momentum, right? Momentum is showing us that area has got orders stacked in it. And if it's got orders stacked in it once, that means one professional trader has found that area of value, then another will find that area of value, and so on and so forth. It just keeps going and going and going, right? Anyone else got any questions? TikTok guys, if you're, I can't answer your questions, unfortunately. My iPad is around the wrong way. So if you are commenting on TikTok, I apologize. But jump in the link in my bio there. You can get into this on my Discord and see everything that I'm explaining to the crew. It's all for free today. Eddie P, do you use the premium discount tool you just had on screen when you were trading, or just as a quick check to see where the market is? Yeah, it really depends, Edward. That's a good question. I will use the premium and discount if the range is quite big. I want to see where that 50% line is, but I'll literally just, like this range I've got on my screen right now is pretty substantial, right? 5,000 to, it's 1,200 points, right? From here to here, in this area here. That's a lot, right? I want to kind of get a visual and see, okay, cool, where's that 50% line sitting? Right, so it's sitting right through here. And as you can see, we broke down, come up, retested that, and we're broken to the downside. And we're continuing by the looks of things. So yeah, I only draw it on momentarily just to get a visual of where price is. Make sure it isn't a discount when I'm buying or selling. And the same goes for the channels, right? So the channel there to here, right? We're in a discount right now. We're in a downward trend. We've pulled up to the extreme of the discount. We should be looking to short there and come down into the bottom of that range. And if you're doing that, that's at about 24,900, and the bottom down there is about 24,300. There's a there's a 600 point move just there to go back into a extreme premium. You could, the other way you can use these guys is, double bottom. If it comes down, hits the zone, bounces back, hits the zone again, and then goes, right? Bounces back up. Right, that's also another way if you're a double bottom trader. There's the break and retest, as Granvin just said. Come down through it, come back, test it, go back, probably double bottom down the bottom there, and then go back up to the top, right? There's several different ways that you can use this channel and several different entry models that you can stack on top to make it work for you. So, if you use the break of structure fair value gap, if you use the inversion fair value gap, we've got that sitting there, right there on that zone where it created it. Right, we've got fair value gap, gets inversed, creates a new fair value gap. Right, we've got a new fair value gap. That thing gets tested pretty close to the 50% line, and then price rockets up. So whichever entry model you're using for your trading, if you use channels, premium, discount, it's all relative. Granvin, go. I see your little fingers typing. Yeah, red folder news, you always let the news unfold, right? You don't trade the news event. CPI is a bit different. You can actually trade that. Let me just get that news event from the other day. Where is it here? All right, so news event, right? CPI. When was that? It was pre-market, wasn't it? 2:30 here, right here. Yeah, so this is how you trade news, and this has been done this way forever. That's your news candle right here, right? That's CPI. So it goes up and into this range, right? It starts here, it moves up, and that's the dealing range of that one candle, all right? What it does is it creates an imbalance. This is your imbalance in the market right here, right? Price, by putting one-way orders into the market, you find your entry at the top here, and you trade that down to where it started, which was that, what is that, the midnight? 8:30. You trade the price back down to the 8:30 where that all took off from, and you get tapped out there just on the first candle of New York. Always let the event unfold and then trade it back in the opposite direction. So if it's bearish, the news event is a bearish candle, you want to trade it back up to where it started. It's an imbalance in the market. It's got to be filled. But for you, Granvin, we're not doing, you're nowhere near being able to trade the news, my friend. Yeah, it's a very strong pattern. That's why we start you on that, to get you, to get the miles on the chart of recognizing that pattern. And when that pattern comes off, you're looking at a 1 to 10, 1 to 15, 1 to 22 I did on that earlier this year. It's a very successful pattern. Low risk, high reward trading, that's what we do. No, not at all. So the Dark Knight has about 5 different faces that it can be. It can have 2 ears. It can be an ascending accumulation. It can be a descending accumulation. One ear could be longer than the other. It really just depends. That's why the backtesting is so important with any strategy, because nothing ever unfolds exactly the same way every single time. The entry model might, but the pattern itself won't. The patterns are multifaceted. There's different. They present themselves differently every time. Oh, hey, my little apprentice, he's good. One of the guys on the weekend, I don't know if is Johan in there? I didn't see. Yeah, Johan, he's right there. Johan, so the liquidity sweep, right? Again, it doesn't happen. This taking liquidity always happens, right? It always happens, but it doesn't necessarily sweep, right? It doesn't necessarily sweep, but when it does, again, that's a high probability trade and it's a high returning trade. And when you recognize that the liquidity run is essential for that to unfold, then you can get some really good risk to reward numbers there as well. 1 to 7s are pretty common. 1 to 10, 1 to 11. When it hits, it really, really does hit. But you also know by looking at the higher time frame where you're at in the market, right? Are we expanding? Are we accumulating? Or are we correcting? Right? It's as simple as that. There's different ways to look at the, as I just said to Edward, different ways to look at the accumulation phases. There's different ways to look at the correction phase. But if you really want to hit it, there's only one way to find and see the expansion, and that is just straight up or straight down, right? We don't want to be messing around with candles in between. We just want straight vertical moves, up or down, and that's it. The accumulation is where things can get changed up and switched up, but it's this leg here that really needs to get your attention. As soon as you see expansion, and on a downward trend, you want bullish expansion, right? Because you want to get it back and you want to rip it back down with momentum. And look what happens here, right? We get that bullish expansion, we accumulate to the top, and then we just rip down a lot, and it just keeps dropping. That's why we want to go on that. But if you have a look at this, if we thought that this was going to be a dark night, right? We actually looked at this a little while ago. This is expansion, but we're on the wrong side of the trend, right? It's going to fail. It's always going to fail because you're not trading with momentum. And even if it did come up, it's not coming all the way up here where it should to correct itself. It's just going to come up probably midway or something and then drop down because you're in a seller's market, not a buyer's market. Let's have a look. We've got another one. Yeah, here's a good example here, right? So expanded to the downside, and then we've come up, we've failed, and then come back, and then it's gone, right? This has gone over a couple of days, but who's got the patience to wait for that? We've been downtrending, right? So that's why we wouldn't want to take that because we're putting in lower highs, lower lows. We've got the expansion here as well. Look, it doesn't come up and it doesn't equalize that expansion run. This one's the same. It finally does because the trend does change, but that's like a day or two later. There's heaps of them, right? If you just switch this off, turn off that indicator, they're everywhere. All different shapes and sizes. Look, there's your double air there, reverse. Again here. Another one. Here's that's the one that we're looking at. This is my this is my favorite example for the last few months. This was in November last year, right? This is one of the really rare ones where we get the inverse, and then we get the actual move as well. So the inverse happened first, come up, and if you have a look at the wicks, it does actually tap it. So you got out of that trade, and then this then goes into from correction into expansion, accumulation, and then this just sold to the downside, and equalize those lows as well. Really, like out of one into another. Perfect. Yeah, generally it's gonna accumulate over maybe the Asian and the London, maybe the London and the New York. New York doesn't always rip. Just depends on what's happening with the pattern, right? It also all depends what stage you're in the market. Are you expanding? Are you accumulating? Or are you correcting? All right. Here again, downward trend. Right, downward trend. So we're looking for bullish expansion. We get that. We get a triple top, and then we sell off to the downside. And then right next to it is another one. Bullish expansion, accumulation, we sell off to the downside. Right? It's always about getting that momentum behind you when you take the position. Here's another one here. Look, bullish expansion, accumulation, sells right off. What session was that? Yeah, New York. New York again. New York and New York PM. Expanding in New York. Expanding into Asia. So it really just depends, right? I think correction is the best spot to find a trade because you have liquidity target since it's correcting. No, it's the accumulation, right? Your best chance of any trade is having your position and your stop at the top of that move. You know, like basically we're picking tops and bottoms constantly, just by knowing which way we're trading. Are we in a buyer's or a seller's market? And if we're in a seller's market, we're looking for buying expansion. Once we've got buying expansion, we wait for accumulation. I mean, this is it on an hourly, Granvin. If you check this, right? There's your 1 hour fair value gap. Gets tested a couple of times on that 50% line. Asia and London, and then rips to the downside, right? Boom. But New York is pretty much the same range as Asia. Asia's actually bigger than New York in this case. But we know we've got 1, 2, 3, triple top. Then we've got that huge gap. If you go down on a 5 minute or something, you're going to find a pretty clear entry there. It's going to be like screaming at me, like, take me, take me. But you want to be placing your order in the zone at the top, right? You want to be placing your order here because, you know, then price can't go back on you, right? You want price to rep, not come back on you. So if we know we've put in the middle, the second high, we know there's a third one, and then we're going to drop. So if you get in on the third, it's very highly unlikely that we're going to come up and take out these highs. And if you can get in here, it's even more unlikely that you're going to get taken out on a long-term trend line. It doesn't have to be complicated, right? It really doesn't. It's just got to be researched and back-tested, because any strategy in the world is profitable. You've just got to understand how to extract the data from it so you can see the data on paper, and then you can tweak and use that data to your advantage, right? So I can find things like my average time and trade, my average session that's going to arise, the time of day that potentially keeps reoccurring, my average RR, is it a, you know, and some of my trades hitting a 1 to 10, but the bulk of them are hitting a 1 to 4, right? And as soon as you really start extracting data out of any strategy, that's when you really start becoming profitable. It's not about looking for the pattern, it's about knowing how the pattern actually works, right? And you can only do that by seeing it on paper, right? When you're doing all your back testing and you're doing all your bits and pieces. You've got to go through as many metrics as you can. You've got to be as thorough as you can, because there's going to be fields that just stand right out. Like they're screaming out at you like, Granvin, stop trading this after a 1 to 5, right? You're going to be, 79% correct if you do this. If the trade's taking too long, cut it, right? How much better off am I if I don't shift stops versus I do shift stops? Like there's so many metrics that go into one strategy that you absolutely need to know, and that's where profitability sits. People just look for patterns, and that's not trading. You're just recognizing the pattern. A trader deals in data and statistics. That's all we do. And people that don't understand that part of trading don't ever go anywhere. They're just trying to trade a pattern, a fair value gap, or some other shitty thing that someone else has told them. They're not doing the work to find it out for themselves, right? You've got to really get into it and go deep down the rabbit hole to find where the source is, right? You've got to go finding the honeypot. And our honeypot is always backed with data. That's the thing that gives us an edge. Everyone puts all the indicators in the world all over their charts. They're using this and they're using that, but none of it works, right? None of it. Not long term. The only thing that does work is data. Data does not lie. Data is the most powerful thing in the world. Look at Google. Every company that's using data or harvesting data is the most powerful company in the world. Trading's no different. It's not a game of patterns and strategies or anything. It's a game of data, and knowing your data is imperative to becoming profitable. That's why that sheet that I showed you, Granvin, that I shared with you yesterday is, you probably opened that up and went, holy shit. There's a lot of fields there for me to fill out. But that's just the tip of the iceberg, bud. That data set goes down like this, and that's where you're starting. All these other guys in the Discord, Granvin, have done 100+ examples. Phil, if Phil's here, where's Big Phil? Is Phil there? Not there. All right. Phil is going in and doing 200, right? And it's just because he's thought of more things that he could test. But the beauty of it is, once you've got all those links, you can just go back now and click every single link, and you can start testing different entry models on the same example that you first retrieved. So that is that. Anyone else got any questions? How often do I check the daily or 4 hour? Well, to be honest, I only look at it I'll just glimpse at it really. So what happens is you get lost in time, okay? And the lower the time frame, the more lost you're gonna get, right? And I mean lost in terms of you don't see the whole picture. Like I've got the luxury of having 4 screens sitting in front of me, right? So I've always got, like up on my top screen, I've got the hourly, the one down, I've got the 15-minute and 5-minute, and then I've got my entry, and I've got all the OBS and Discord stuff on the other one. But I always see the bigger picture, and that's really important, right? Because this line, let me just get this back. There we go. Right, so check this. I'll come in here and I'll get the daily, and I'll just find the trend, right? So we're doing lower highs, lower lows right now. And I'm cool with that, right? I'm just gonna draw this line out. I'm just gonna have it on the chart. All right, I'm gonna pull it up closer to price, don't get me wrong, so I can see that label was sitting there. If I go to the 5-minute, maybe closer. Anyway, you get what I mean, right? I'll go with the 15. There we go. There we go. Perfect. Right. So now I know, like, so this is the Bible, right? This is the thing that dictates what direction I'm going to be trading in, right? I don't want to mess around with trades that are going long. Like, it's a waste of my time, right? Again, go back to data, go back and test it. See how many times trades go against you, trading against the trend, versus trades that go with you, trading with the trend. All right, so I'll have that on Ed, and I'll just quickly scan it at the beginning of the week. Now, if price comes up and we do one of these guys, right? Come back, we breach out of it, come back and test it and go again. Then that invalidates that for me, and then I'm drawing another line, right, through my lows and highs, and now this will become my new trend. I might have to do this. Might have to call this one maybe an hourly or a 4 hourly, right, to get these low points here. But it invalidates that. And then if that's the case, as soon as I get up and out of this area, I'm only looking to buy now, right, until this one gets breached. So to answer your question, I'll do it, I plot it in, and then I don't really look at it because I know what that chart says. Now, every single session, I'll go back, right, and I just check the candle. This is the only thing I do as well. I just go here and I just check to see what the candle is doing, right? So obviously we got a pretty good doji there. It would represent that we're going up for the day. I want to make sure that if we are going up, that I'm looking for a sell position on the way back down. That's the only time, like I'll spend seconds on that chart, and then I'll go to the 4 hour and I'll spend seconds on that. And again, I'm just matching that analysis I just did. As you can see, we're putting in higher highs, higher lows, and then we've just come down and engulfed these 3 candles. So we're on the bottom of that channel, and we're in a pretty good position to be selling again on the 4 hour. Briefly is the answer, I suppose, Edward. Just a quick flash, and then you go. I spend the majority of my time on the hourly, right? I want the hourly coming up into a channel, up into a zone, and that's when we're, of course, in a bearish market, seller's market. On the hourly, I see a decay formed. Can you see if it's a valid decay? Which one? Are you talking about this? This here? Or this? People are so eager to trade, right? And I get it. I've been there myself. So here, man, just put a screenshot in the chat there, Granvin. Yeah, I get it, right? Like everyone's so eager to put trades in, turn up to a session, make money. I understand that. I've been there where I have to get up, jump into the session, and I just have to trade. But once you understand that there's strong areas that you can trade from that are way higher probabilities than sitting there every single day, trying to grind some points out of the market, like this play, for instance, right? This is a valid trade from us. It's 1, 2, 3 candles. It is 406 to 856. So we're about 540 points in just 3 candles, 3 hourly candles. No, that's not expansion. That's a move within the move, Granville. Zoom out. And young man, get off your phone. Don't have a look for patterns on your phone. Once you find, what was I just saying? That's right. Once you understand that just sitting here waiting for this to happen versus getting absolutely wrecked coming through here, right? It's probably around there, yep. Right, this whole zone was over the last week, right? It took like 4 days for that accumulation. But we know that with every day that goes by, we're closer to this point, and this daily trend line certainly gave that away from us. If I know this, right, from experience, that all I've got to do is just sit here and wait, like 1, 2, 3, 4 days, right? And as I said, every day that it doesn't go, I just wait another day, right? But then I can capitalize on a 500 point move, 15 to 20 NQ contracts, and I'm making someone's wage in the matter of 3 hours. I'm making their yearly wage, right? Like, it's time versus effort. I'm being exposed in the market once, and I'm able to capitalize on a larger move, right? And this is no different. This one here. Accumulation is only the 2 session accumulation, like we said with Granvin just before. But again, I know that if we get that, we get near this line and we get the entry point, then I'm going to get this move here was, let's say 26,000 down to 25,250, so 750 points. Again, 15 to 20 contracts on NQ, like, do the math. One contract on NQ per point is worth $20. And there's 750 there times 20, well, let's say 15 cons. 720 points times 15 contracts at $20 a point. Like, that's some serious cash, right? You don't need to be in the market all the time. I'm only exposing myself once. I'm putting 1% of my account size on the table just for that one move. Whereas all through here, this is what accumulation is, right? Accumulation is buyers and sellers not understanding what phase of the market we're in, right? This is all just retail, backwards and forwards, until institutions jump in and send it, right? Institutions come back and they want to come back and even out this run here. It's all it is. It's as simple as that. Same again, right? Accumulation, bam. You can see retail can't put candles in like this. It's institutions, right? Institutional play. So if you can wait there and sit there and just be patient, that's where the gold sits, right? That's where the pot of gold sits at the end of that move. Whereas, like, a lot of people, you'll see, they have to trade here, they have to trade here, they have to trade here, and they have to trade here. They can't not trade. And that's not the key to trading. You're overexposing yourself to the market. Every single time you're putting 1% in, right? So you're risking 4% on over 4 days. You're probably only getting 200 points over those 4 days, but your total is about 800 points, but you're risking 4 points to get it. 4% to get it. I risk 1% to get 750 points. Right? That's logical, right? Expose yourself less to the market, capitalize on a bigger win. Not all these, this wouldn't be 200 points every single time either, but I hope you understand where I'm going with that. It's a much more efficient way to trade. People that I see trading every single day don't understand the market. They just don't understand how to make money out of the market. They're chasing patterns that they identify. That's not trading. No, that's not true. That's not true at all, Granvin. You need a high reward system. Yeah, to make money and to be profitable, you need a high reward. You need low risk, high reward. 1 to 3s will not make you profitable. You'll struggle. You're drowning the whole time, right? For every one that you get wrong, you're now 1 to 2. Get another one wrong, you're a 1 to 1. Whereas if you get a 1 to 10, you've got 10 times that you could potentially be wrong. Okay, so if you're doing 2 to 3, 1 to 10 RRs a week, then there's 30 times across those 3 winning trades that you can be wrong before you're going to lose 3% of your account that you risked, right? But as a 1 to 3, if you're shooting for a 1 to 3, there's 10% that you're putting on the line to get the same amount of return. So that's where it doesn't work out. You're risking more to get the same return. No, it's not. The win rate's not. It's not about trading's not about the win rate, right? You can make a strategy that's 40% right all the time, profitable, right? It's the win rate. It's the risk to reward, not the win rate. Sorry, the risk to reward, not the win rate. The win rate doesn't have anything to do with it, right? It's the low risk, high reward. So where you want to go. All right, guys, I'm about to finish this up. I hope everyone enjoyed that little session. Do go through this. I'm about to upload this on YouTube, so it'll be up there pretty soon. If you're not subscribed to that, jump on. I've only got a couple of followers. I've been doing this for 15 years. If anyone didn't know, I've been in these markets for a long, long time. And there's a lot of tricks and there's a lot of sauce that a lot of people just won't tell you, right? I feel like a lot of people are out there and they are profitable, but they just don't want to share it with you. And I'm not that guy. I don't care about your money. I don't need it. I've got my own. I trade my own self-funded account most days of the week, although I've just started on prop firms. But I've passed my first 2. The first 2 ever prop firms I've just passed both of them. So yeah, I don't do this for money. I've got my own. This couldn't pay me enough. I can do trades like that on the reg and make more than any of these groups could ever pay me. So if you want to know the source, then come and join us. Jump on, see what it's like, learn these patterns, learn how to trade efficiently, right? Number one, learn how to be comfortable in the markets without heart racing, without all the emotion, because it's not what we do, right? It's transactional. If I lose a trade, I don't really care. And I'm using a lot of contracts. If it's on my self-funded account, I'm putting down a lot of money on that. And that should shake you, but don't forget, I've started where everyone else is, right? I started with nothing and I built and built and built as I went on. And as I've gone on, my pots got bigger and bigger, and so has my position sizes. So now I'm really, it does not faze me one bit. I don't celebrate my wins and I don't get down on my losses. It's just part of the game. That's a very small fraction of what it is that we do as traders. The primary thing that we do is we crunch data, and we're statistics orientated, right? Everything is based on statistics, and the more data that we can get, the better off that we are. A lot of people just don't tell you guys these things. It's not rocket science. You've just got to go in and go deep down the rabbit hole, as I was saying, to find out, is this strategy successful? And if it's not successful, am I testing it over a broad enough base? Am I testing it over enough examples to get sufficient data back? Probably not, right? There's a number there that you should be aiming for, and most people don't even get anywhere close to it before they'll flip to another strategy because they think that one didn't work, and then they're looking for the next one. If you see anyone talking about a 90% win rate on a strategy, they're probably full of shit and they've only tested it over 10 times. There's no way in hell you can figure out probability over 10 trades. So jump on board, links in bio, jump on that YouTube as well. I'm going to upload this if you want to watch it again to get those zones mapped out. And I'll see the Discord guys. I'll see you guys tomorrow for the live, usual time. Yeah, thanks for your time. Ciao.